Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields in the post-June FOMC trade. Boy, they really tried to get the yields to move up. We got them touching 3%, barely, and now we're way back, even below that 50% of the May range we've been talking about so much, that 294, 295 level. Looks like yields are going to go out the week at around 291. You would have thought after what we saw from the Fed and the way things traded that we probably would have seen yields push higher, but we're actually going to settle lower week over week. And I think right now we remain in that range. We're not seeing any kind of breakout here. We're not seeing any kind of surprises. I think the market, the big want trade is to see yields go higher, and the trade of pain is yields to go lower. And right now the trade of pain is starting to win. It's only a lean towards the trade of pain. We're not seeing a full-out breakout move to the downside in yields. However, after what we heard this week and some of the data we've seen, we would have thought we would have gotten higher yields. We haven't. And volatility, likewise, is, say it with me together, trending lower. Hey, how about that? We're down to about 1 month lows. Post FOMC, that is expected to see volatility lower. We did see a bit of a bid prior to the Fed meeting, but nothing that would scream panic. And right now, as the market settles into that comfortable range, it's going to come from some other area that's going to bid Treasury volatility. It's going to come from either sell-off in equities. It's going to come from something in the emerging markets. It's going to come from something over in Europe. Those are the events, or those are the areas that could affect Treasury vol, because the flight to quality bid, something we have not seen in a long time in the Treasury market, that is going to come back, and it's going to come back in big size if things really start to crumble in any one of those three areas. So right now, volatility is probably a buy as we trend lower, because we're really not seeing any fear. There's no reason to break out of the range, but I think if we break out anywhere right now, yields are going to go lower, hence the trade of pain, and probably why you should be buying some volatility as I speak. And lastly, let's talk about what happened this week with the Fed. Chairman Powell sees a strong economy. He wants to raise rates another 2 times this year, a bit of a surprise, I think. And he also wants to look at next year as being another hawkish year. So I think right now in adding press conferences and forward guidance to all FOMC meetings, and I think that right now the bond market is looking at it as, wait a minute, the short end yields are seeing a bit of a pop higher, but we're not seeing that same pop in the back end, and hence the yield curves are continuing to flatten. So right now it seems to me that 2s, 10s, 5s, 30s, however you look at it, those are showing a lot of uncertainty and maybe not believing what they're hearing from the Fed. They want more proof. Maybe they want to see some actual data, I think you get that September rate hike, which is now priced in, along with a December rate hike. That could be enough to prove the market that things are really moving along. However, you have to keep an eye on the economy. You have to keep an eye on inflation. And I think you certainly most have to keep an eye on what's going on in Europe. They want to join the hawkish central bank party. Unfortunately, they don't have a ticket, and right now they're going to try and force themselves into it. And I think that could create a little bit of a problem over there, which will feed into over here. Is that once again flight to quality bid that we haven't seen in the Treasury market for some time. So heading into the weekend post FOMC, bond market seems strong, equities seem strong, but we do have a lot of concerns on our board here as we watch around the globe, things that could affect the U.S., things that could affect the Treasury market, not necessarily things here at home. This is Todd Colvin coming to you from the floor of the CME Group.